This content is for educational purposes only and is not financial advice. Investing involves risk. Do your own research and consult a professional before investing. Hello everyone, I'm Oldfish. If you're looking for a spiritual anchor in the Canadian capital market that can survive bull and bear markets and stand tall, it's undoubtedly our big six commercial banks. From the 2008 financial tsunami to the global pandemic in 2020, the Canadian banking system, thanks to extremely strict regulation and conservative management, didn't see a single failure. It even maintained a record of paying dividends continuously for over a century. This kind of asset resilience is rare on a global scale. Betting on this absolute confidence in the underlying assets, the fund company Evolve recently made a very bold move. They launched a new ETF that purely bets on the big six banks, ticker symbol SIXY. This has confused a lot of friends who hold Evolve's star product, Bank. Does the appearance of SIXY mean that the steady strategy of Bank, which combines banking and insurance, is outdated? Should we swap our holdings? Today, let's dive deep into this. First, let's look back at the classic Bank ETF. The strategy is relatively balanced. Besides banks, it also holds insurance giants like Manulife and Sun Life. Its covered call coverage is capped at 33%, it pays monthly dividends, and the leverage ratio is controlled at a relatively mild 25%. Now let's look at SIXY. It's dialed almost all the parameters up a notch. The covered call coverage is 50%, which means higher dividends. It also has higher leverage, pays out twice a month, and focuses purely on banks. However, the management fee stays the same as its star product Bank at 0.6%. Why Evolve apply such aggressive strategy on SIXY? Next, let's tackle the most controversial topic, the covered call coverage ratio. Higher covered call coverage means giving up more upside potential in exchange for premiums. Since SIXY writes call options on 50% of the portfolio, it implies that the underlying assets need more explosive growth to maintain the net asset value under such an aggressive strategy. Objectively, Evolve has data backing this design. First, look at the sole active Canadian Core Financials Equal Weight Index tracked by Bank. It rose 34% in the last year. Since it started in 2007, the total return is 172.18%. The volatility is 20.49%, and the max drawdown is minus 60.07%. On the other hand, the sole active Equal Weight Canada Banks Index tracked by SIXY has risen 43.85% this year. Since its inception in 2007, the total return is 665.83%. Its volatility is 19.69%, and its max drawdown is minus 54.56%. So, historical data suggests that SIXY's 50% covered call coverage and 33% leverage ratio makes some sense. Because a portfolio with just the Canadian Big Six banks not only has higher growth but also slightly smaller drawdowns. So, SIXY's mathematical logic is to use the stronger explosiveness and recovery elasticity of the underlying bank stocks to offset the potential upside capped by the 50% covered call coverage. Combined with 33% leverage, this strategy can indeed produce a beautiful yield curve in a slow bull market or a volatile uptrend. Of course, in investing, we can't just look at historical data because history doesn't dictate the future. At the end of the day, it comes down to whether the insurance companies in Bank are worth buying. We need to see their true colors. They are actually global asset management giants disguised as insurance companies. First, banks make money on interest spreads, while insurance giants like Manulife and Sun Life earn management fees. They manage trillions in assets, so as long as global stock markets rise, their profits skyrocket. Compared to the stability of banks, they have more elasticity. Second, banks are mainly stuck fighting over the existing market in North America, while insurance giants have long put down roots in Asia. Buying them means betting on the rise of the Asian middle class, a growth driver that banks can't provide. So here's the question. Since insurance companies have new profit growth sources that banks don't, why have indices with insurance lagged behind pure bank indices over the past decade? It really boils down to three things. First, the past decade was an era of low interest rates, which was good for bank lending but a nightmare for insurance investment portfolios. Second, in 2008, insurance companies had a very hard time. Manulife's stock price dropped by more than half due to errors in their hedging strategy. In contrast, no Canadian bank cut its dividend in 2008. They only froze growth. Third, to be honest, banking is a monopoly business where making money is easy. Insurance is a competitive business where you have to fight for it. So in the long run, banks are indeed more efficient moneymakers. But investing is all about the future. Now that interest rates are returning to normal, the investment side for insurance has come alive. Coupled with Asian growth, insurance stocks are undergoing a valuation re-rating. Just because they lost in the past doesn't mean they'll lose in the future, and that's the bet. Actually, if we compare the returns of Bank with ZEB, an ETF tracking the big six banks, you'll find that Bank's growth in recent years hasn't actually lagged behind ZEB, which purely tracks banks. Although SIXY's logic holds up in normal conditions, we need to be wary of V-shaped market reversals. If the market panic dumps and then rebounds violently with liquidity support, SIXY's high covered call coverage ratio becomes a drag. In such extreme market conditions, 50% of SIXY's positions will be capped by the strike price, unable to enjoy the gains from the rebound. In fact, in April 2025, the market saw a deep V-shape due to tariff scares. Almost all covered call funds with 50% coverage significantly lagged their underlying assets, such as Evolve's own QQQY and the well-known USCL and QQCL. On the other hand, ETFs with low covered call coverage, such as Evolve's own ESPX, which has a classic max coverage of 33%, performed much better than the likes of USCC. Therefore, by comparison, BANK only has 33% coverage, meaning it keeps 67% upside exposure to fully participate in the market rally. When facing violent fluctuations and rapid rebounds, BANK's strategy of leaving some room can provide higher total return potential. Finally, to sum up my view, Evolve actually provides tools in two different dimensions. If you have absolute confidence in the resilience of Canadian banks to survive bull and bear markets, and your primary goal is to get extreme cash flow, then SIXY is a logically sound, aggressive tool. But if you care more about balanced asset allocation, hoping to gain global growth opportunities through insurance stocks while keeping enough offensive exposure to avoid getting left behind when the market does a V-shaped reversal, then BANK, with moderate leverage and only 33% coverage, remains a more solid choice for a core holding. Actually, friends who've been following my videos should know that my personal style of choosing ETFs leans toward those with less covered call coverage. It's not that I don't want higher yields, but rather than trusting a fund manager's judgment, I trust the market more. Personally, because of the covered call coverage issue, the SIXY ETF hasn't reached the perfect form in my book. I know the downsides of high covered call coverage, and Evolve knows them better than I do. Perhaps only when passive income investors come back to their senses and stop chasing dividends blindly will better products be born. I'm old fish. Making these analysis videos isn't easy, so please like, comment, and subscribe. This really helps me out. See you next time.